Hello and welcome to Supercharge, taking your business to greater heights. It's presented through a partnership with Workforce Solutions Northeast Texas and Small Business Development Centers. Funding for the Entrepreneurship Training Program was provided by the Texas Workforce Commission and Workforce Solutions Northeast Texas. The purpose of the Small Business Development Centers is to assist entrepreneurs to start and or operate a small business. Welcome to Module 4, Analyzing Financial Performance. I'm Julie Parr. Today I'm joined by Jim Struve, a counselor with the Paris Small Business Development Centers. Jim is here today to lead us in a discussion on how to analyze your financial performance in your business. The information contained within this presentation is given for informational purposes only and should not be construed as legal advice. Tax laws are subject to frequent changes, and you should consult a tax professional regarding your specific situation.
Hi, I'm Jim Struve with the Paris Small Business Development Center. The topics we're going to be talking today is business analysis, the accounting environment and financial statements, the balance sheet, the income, which is a profit or loss statement, and cash flows. The process of evaluating a company's prospects and the risk for the purpose of making business decisions is one of the key functions of any business analysis. The financial statement analysis is an important part of this business analysis. How can owners, investors evaluate risk, return, or trade-off? And what is the difference between profit and profitability? You'll see here a role of accounting and financial management. It starts with the investing and financial decisions that need to be made, and they all start with the balance sheet and the income statement. From that, of course, then we can determine the analysis of the balance sheet changes, which is used for a statement of sources and uses of funds. We can do ratio analysis such as liquidity, activity leverage, and profitability. And then, of course, cash flow analysis, which is the cash flow. From the sum of all of these, then we can do the evaluation of the company's risk to reward. Just to go through several transactions as you see on your screen here. The first one is an owner invests some money to open an office. This is where we increase the assets. We have no liability in this transaction, and there's an investment of $50,000. The second one example is $40,000 is borrowed from the bank on a note. Well, you can say that assets are increased by the $40,000 cash and liabilities are increased by $40,000, which is the note payable to the bank that you're going to have to pay back over time. The third example is inventory costing $3,000 was purchased on credit. Once again, that's an increase to an asset account, which is inventory, and an increase to the liability, which is an accounts payable. Example number 4, services were performed on account for $10,000. Here again, there was $10,000 that goes against accounts receivable because you've yet to receive the money in, and owner's equity or revenue of $10,000. This is a P&L or profit and loss transaction. Number 5, salaries of $5,000 were paid to employees. Once again, this is a reduction of cash in the assets, and it's also an expense account over on the profit and loss because these were salaries paid out. The sixth example here, $500 of inventory was used. Obviously, you're going to reduce inventory by $500, and you're going to show an expense or cost of sale of $500. The last example here is $1,000 was paid on account to the inventory vendor. Once again, you're going to reduce cash for $1,000, and you're going to reduce accounts payable by the equal amount. Events or transactions that affect the accounting equation. These events are expense transactions that are reflected on the income statement. The relationship between the balance sheet and the income statement. The balance sheet's purpose is to show the financial position of the company at any particular given in time. We use the term snapshot because at any time you take a picture of the company, this shows the financial position. The income statement, on the other hand, shows the change in the company's net worth over an accounting period. In other words, how much is the company either profiting or not profiting over a set period of time. This is also called accrual accounting. Here's an example of the balance sheet. You can see on the left-hand side the assets such as cash, receivables, and inventory. On the right-hand side, you see the liabilities and the owner equities. There's current liabilities and there's long-term liabilities. Here we're only showing the current liabilities of accounts payable and of a note payable, and the equity that was invested in the business and the retained earnings. Now, the retained earnings is the profitability or the loss of the operation for that period of time. Here's a picture of an income statement. It shows in here that we had sales of $10,000. There's no cost of sales because this is obviously a service business, so the gross profit's $10,000. The expenses are shown here of salary and inventory, and this is where the net income of the $4,500 you just saw on the previous slide. Now we're going to talk about the analysis of balance sheet changes. The sources and uses of funds is a key to determining financial decisions. The balance sheet is a cumulative record of sources and uses of funds. A typical use of fund is an increase in an asset account. If you're buying something, it's a use. If you decrease a liability account, it's also a use. If you decrease in a net worth account, that's a use. A source of funds is a decrease in an asset account. You've sold something. An increase in a liability account is a source, as is an increase in a net worth account. Here is a slide that shows a partial example of the balance sheet changes. Between any period of time of 12/31/09 and 12/31/10, you can see the changes in the cash, accounts receivable, inventory, accounts payable, notes payable, and retained earnings. You can tell from this slide on the far right side which is actually a use and what is a source. We have now reclassified those and put all of the uses together and all the sources together for easy presentation. Now we're going to talk a little bit about the sources and uses of funds statement. In taking an analysis of this, you should concentrate on large sources and uses. Anything that seems to be very large number, you need to pay special attention to. You need to identify sources that would normally be expected to be uses and vice versa, because they could be in there just backwards. Compare the current period statement with those of past periods. Look for major differences. Any kind of analysis you do is always comparing one period to another. Now let's move into talking about ratio and analysis. There's 4 different forms of ratios that we look at. There's liquidity ratios, activity ratios, leverage ratios, and profitability ratios. When we talk about ratio analysis, it's very important to take a look at a cross section. Not only your particular business, but other businesses in your industry. Then there's the trend ratio analysis that compares successful values of ratios over your industry over a number of years. Liquidity ratios. The most common liquidity ratio is the current ratio, and that's just simply current assets over current liabilities. The next liquidity ratio is a little more intense, and what this is called the acid test ratio, or the quick ratio as it's also known. This is any of your current assets that can quickly be liquidated into cash. So we're talking about cash, marketable securities, accounts receivable, anything that can quickly be converted into cash, and you take that over as the numerator and take that over current liabilities as the denominator, and that gives you an acid test or a very quick ratio. In every case, that'll be smaller than your current ratio. Now we're going to talk about activity ratios. Activity ratios are ratios that deal just with activities. We're talking about sales per day. You can take a look at the chart here and see that you'd figure this by taking your sales over a standard year of 360 days. And that kind of works down to an average collection period on how often you're able to collect on your sales. Next activity ratio is inventory turnover. This is where you take your cost of sales over your ending inventory and tells you how many times your inventory is turning in a year. An average payment period is another activity ratio where you take your purchases per day over the same 360 days and get your average payment period. Another activity ratio is the fixed asset turnover. This is sales over net fixed assets. This is a good measure of activity to show how well you're utilizing your assets in your business. So total asset turnover, you can see, is by taking sales over your total assets. Now we're going to talk about leverage ratios. There's the debt ratio. This is your total debt over your total assets. Also, a leverage ratio is your interest coverage ratio. This is very important to the banks. They're taking a look at interest before income taxes and dividing that by your interest expense to find out what kind of a ratio that you have as far as the repayment of debt is concerned. That's a leverage ratio. Profitability ratios. Gross margin is probably the most common and utilized profitability ratio there is. This is just taking your gross profit and you're dividing it by your sales, and this shows you how much profit you're making on each individual component that you're selling. Net margin is your earnings divided by sales, and of course that's a much smaller ratio. Return on assets is another profitability ratio. This is taking your earnings before interest and taxes and dividing it by your total assets. Once again, it is a utilization of your assets. And return on equity is earnings after taxes divided by your net worth to show how much your earnings are as it relates to the value of your business. Now let's talk a little bit about the implementation of ratio analysis. As you can see from the chart here, we have different components as we talked about. The liquidity, which is the current ratio, and the asset test ratio. We have the activity ratios, such as average collection, inventory turn, fixed asset turn, and total asset turnover. Then the leverage ratios, the debt ratio, and the interest coverage. And then finally, profitability for the gross profit, the net margin, return on assets, and return on equity. You can see all the various different ratios we have here as we've talked about: liquidity, activity, leverage, and profitability. The most important thing in the computation of these ratios is really the trend analysis. As you see on this slide, you can see all of these numbers and all these ratios, but what's important is to compare them period to period to period. That is where you're really going to get the information and the real meaning of what ratio analysis can do for you. Now, there are some limitations to ratio analysis. Some industries are often difficult to define. There's not a baseline to understand what is normal versus what your business needs to be. There can be differences in accounting practices that can render comparisons meaningless. Accounting promulgations change from one year to the next and often back again sometimes. And an industry analysis may not provide a valid target because your portion of an industry may be just segmented and not the sum of the whole industry. And also, an industry analysis may not be a valid norm for any future operations you're going to have. What you're doing and how you're going to do it may be a little different than how other people do it. Now we're going to talk about the cash flow analysis. And the cash flow analysis is one of the most important analysis that you can do. It is, as I said, one of the most important financial statements that there is, because the business owners must have a fundamental understanding of what cash flow is and how cash flow works. It's important to understand that many businesses don't succeed based on cash flow and not profitability. There have been many companies that have been profitable but have not sufficient cash flow to support the company. Short-term financial planning is one of the main objectives of the cash flow objective. You have to understand what working capital you might need. This is often developed on a month-to-month basis. Sometimes in some industries with some businesses it may be week-to-week, but generally, and what's usual and customary, is on a month-to-month basis. The cash flow analysis, as I said, will also show all the expected cash inflows, which are the revenues. It also shows all the expected cash outflows, which are the expenses. Determine the amount of cash that will flow into your company during the month is one of the projections of the revenue side of the cash flow. This can be brought up through units of sales. It can be brought up through the dollars of sales, but sales and the number of units or products you're selling is the basis for any of the revenues you're going to derive in your business. To determine the amount of the cash that will flow out of your business during any month is the expenses. And these expenses can be loan payments, they can be interest, etc. Here is a sample cash flow that shows a beginning balance. Just like any cash flow statement, you have to have a beginning balance, you have to have the cash coming in, you have the expenses going out, and an ending cash balance, which then becomes the beginning cash balance for the next period. As you can see on this statement, everything looks fine until we get out to the last month, and then all of a sudden there's a problem. So what the cash flow statement does for you is able for you to look into the future, identify the problems, and manage the problems in advance. The longer you have to manage a cash flow shortfall, the better off your business is going to be.
The information contained within this presentation is given for informational purposes only and should not be construed as legal advice. This concludes our presentation on analyzing your financial performance. Thank you to Jim Struve of the Paris Small Business Development Center for leading our discussion today. We hope that you will join us for our other Quick Start training modules. Please contact us for additional assistance with your specific business. For businesses in Delta, Hopkins, Lamar, and Red River counties, please contact Paris Small Business Development Centers for assistance at 903-782-0224. For businesses in Bowie, Cass, Franklin, Morris, and Titus counties, please contact the Northeast Small Business Development Centers for assistance at 903-434-8237. Workforce Solutions Northeast Texas is an equal opportunity employer/program. Auxiliary aids and services are available upon request to individuals with disabilities. Relay Texas TDD, his number is 1-800-735-2989. Voice is 1-800-735-2988. It serves Bowie, Cass, Delta, Franklin, Hopkins, Lamar, Morris, Red River, and Titus counties.